Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Willie. With all the turmoil this stock has been through, should you buy Credit Suisse? The Swiss bank Credit Suisse Group has struggled this year, with the stock now trading down close to 60% and hitting all-time lows. Credit Suisse has been closely associated with several scandals in recent years and now must put together a transformation plan which could involve raising capital at a distressed valuation. Still, one might argue that a lot of the bank's troubles have been priced into the stock, which trades at about 26% of its tangible book value or net value. That means you can buy a share of Credit Suisse for 26 cents on the dollar. And if the bank can turn things around, there could be a lot of upside ahead. Given this absurdly cheap valuation, is Credit Suisse a stock to buy? Morris Money breaking news. Subscriber inflation data has been released. Month-over-month subscriber inflation is 15.9% below analyst expectations. If you want to raise inflation, subscribe to Morris Money. Credit Suisse's name is in the headlines a lot lately, and not in a positive way, with spreads on its credit default swaps, basically insurance against the bank defaulting on its debt, widening recently. There's talks that the bank could be on the brink of failure, which leads some to believe that a Lehman Brothers-like collapse could happen. This situation is very unlikely, just because Credit Suisse is simply too big to fail. The bank had a common equity Tier 1 capital ratio of 13.5% at the end of the second quarter. Its regulatory requirement is a minimum of 10.5, meaning it has a lot of excess capital right now. On the bank's second quarter earnings call, the now former Chief Financial Officer, David Mathers, I apologize if I butchered his name, said the 13.5% CET1 is one of the highest capital ratios the bank has ever reported. Credit Suisse's U.S. subsidiary is also incredibly well capitalized with a CET1 ratio of more than 27% at the end of 2021. The bank is not without risk and does have exposure to the oil and gas sector and Russian credit, but not the kind of exposure that would bring the bank down. That said, Credit Suisse has no shortage of problems, and its investment bank has been involved in many major scandals in recent years that has put it in a very bad position. The bank had as much as $20 billion of exposure to Argos Capital before the fund collapsed, resulting in a loss of $5.5 billion. It also took a $1.7 billion write-down from its exposure to financial services company Greensill Capital, which failed in 2021, and has been involved in other scandals as well. After the multiple scandals, Credit Suisse will now likely need to overhaul its investment bank and fix risk management to prevent further losses that could arise. The investment bank is a big part of Credit Suisse's business, and restructuring the division could be a costly endeavor and take several years. On its last earnings call, management laid out strategies being considered: make further investments and prioritize asset and wealth management, restructure the investment bank, and cut costs. There's also been several rumors that it might split the investment bank into 3 separate units, according to Financial Times. Some analysts estimate that the bank could face a capital shortfall due to the restructuring costs. That doesn't mean it would have enough capital to survive, but its capital ratios might dip below its regulatory requirements or not allow it to maintain a reasonable buffer. Banks can dip below these levels and still operate fine, but they might need to limit capital distributions to shareholders. Credit Suisse already had to cut its dividend and has not been able to buy back shares either. Furthermore, this shortfall could require Credit Suisse to raise capital. Not only would this be incredibly dilutive to existing shareholders at the bank's current distressed valuation, but it might also be challenging if prospective new shareholders are not convinced that the bank can turn things around. Another option would be to sell its stronger performing businesses to raise capital in a non-dilutive way, but then earnings are going to be challenged further down the line. So the question comes, should you buy Credit Suisse? Until there is more clarity about how Credit Suisse will proceed, you might want to stay away from the stock, but not because the bank could fail. A potential capital raise would dilute your position if you buy now. And while banks executing turnarounds can be great opportunities, there needs to be a clearer transformation plan, including what units might be sold and what will happen to the investment bank. In recent days, Credit Suisse has looked to sell their Savoy Hotel in Zurich. I apologize if I butchered that name. And they're also trying to pay down some of their existing debt, upwards of $3 billion. I wouldn't say this would change my mind about potentially buying the stock, but it shows that they are trying to make an effort in turning the company around. This aside, let me know what you think about Credit Suisse right now. They're definitely in a tough position, but they might be a great stock to look at if you're looking for a long-term company that has the chance of turning itself around. All this aside though, let me know what you think about Credit Suisse below. Please don't take this video as financial advice, and thank you for watching Morris Money.